Good afternoon. I'm Brian Akers from Akers Financial Group, certified financial planner professional.
And I'm Alex Monk from Akers Financial Group, also a CFP, Brian.
We welcome you to our talk on this webinar today. The webinar today is called Managing Market Volatility. We have a lot to cover in a very short time. We do thank you for listening today, and we're going to go right straight to our slides so we can begin our little talk. All right, so hopefully you've been experiencing none of the things we're going to talk about today, but what we're going to do, Akers Financial Group, we have offices in Lutherville and Forest Hill, Maryland, and what we're going to do today is really talk about our company and talk about managing market volatility in retirement years. We do have a radio show on Saturday mornings, 105.7 The Fan at 11 a.m. Myself and Alex are hosts of that many of the Saturdays. You can join us any Saturday you like. Or if you'd like to see a recording or hear a recording of our show, you can go to our website at akersfinancial.com.
Absolutely, Brian. We're those radio guys that get everything warmed up before the sports.
Absolutely. That's on Saturdays at 11. You can always join us there. We've been doing that show time for 3 years now. Now we got to give you some very important disclosures. Alex and myself are certified financial planner professionals who are also licensed life and health insurance. We're licensed as security representatives, as stockbrokers, and we're also licensed as investment advisor representatives. This is through Kalis Capital for our security license and Kalis Management for our RIA. There are many licenses to be able to take advice and then implement it for our clients, and we have all the license needed to provide that for people here in Maryland or throughout the country. We're licensed in over 20 different states, and we look forward to possibility talking to you in the future about what we do. Now, this talk today is going to be all here on the web. And on the web, what you're going to have is opportunity to chat with us as we're talking. So yes, we'll be on the sideline while you watch this video on this webinar. And what's going to happen is you're going to have a chance for a live chat. It's on the right of your screen, that live chat box. Won't you go ahead now and say hello? We'll say hello back. It's good to check in with you and everyone. We do welcome you to our talk today, and we look forward to going through a lot of things. All right, Alex, ready to get started?
I was born for this.
All right, that's good. All right, what you need to know. You need to know a lot of things when it comes to your retirement planning, but let's first of all start about stock market.
Yeah, so the stock market is technically a growth engine, right? So we place the stock market for our clients as a way to keep up with inflation over the long term.
Absolutely. Inflation is where you're spending your money on goods and services, and the prices keep going up. What's happening this year is we've been through a lot. Market volatility is something we are experiencing each and every day. So what we want to talk about is the purpose of your money. What you need to know is stock market's a growth engine. You also need to know that it is not an income engine. If you want reliable, predictable income, we don't use the stock market for that part of our income plan.
Just by the nature of the stock market, it's volatile, right? I mean, that's what this whole talk is about. We don't want our clients that are retired to have income that is volatile.
Absolutely. Now, retirement is different. When you're retired, you want to know where your income is going to come from. The market volatility is when you're growing and putting money in. You want it to be down. You want to buy low and sell high later. When you're retiring, you want the market to be high, and then you want to reduce your own risk as you enter your retirement years. And so as we talk about market and market risk, let's talk about the market for the last 10 years, Alex.
I mean, the last 10 years have been great. It's coming right out of the last major kind of recession, that the housing crisis that we had. And it's been good. I mean, that line right there looks pretty straight. I mean, there's some bumps in the road, but you could draw a line that would pretty much get you there.
Yeah, I can't really draw a line here, but I'm showing you with my magic arrow. So what you'll see 2018, the market took a big fall at the end of 2018 and then really roared through the end of 2019. And that was a full triple in value from 2009 to 2019. If you go back 2000 and 2009, all the way to March 9th, 2009, the market was at its low. And then it took 7 years for the market to come back to where it was at the high back in the fall of 2007. Now, that was a financial crisis, and that's a little different than we've experienced even this year.
Absolutely. So that was just our financial system, right, being over leveraged. So right now we got a whole different mess of things going on, but it results in the same thing. And this chart right here shows it. It's volatility.
And the volatility of a global pandemic. When you're thinking about retirement, you think about what could be the worst case scenario. What you look here is you look at a cliff. You see us hitting all-time highs on the stock market in February of 2020, and then to begin going into this pandemic, and then the country was shut down and locked down for many months. The market really crashed hard, losing in the 30 to 36% range. So if you were getting ready to retire and had 100% of your money in the market, what you're experiencing is extreme volatility.
And the worst thing that you can do is sell out of fear. So that downward line there, that is fear driven.
It was fear driven. The sellers were running out there, saving their money by trying to get out. So what happens when the market starts to go down, you have this fear, and the fear tells you to sell. Just like in February when the market was hitting all-time high, people were excited, they were greedy, they wanted that market to rise and to keep rising forever. What happens in the market itself is that there was a lot of government help, which then helped support the market. And there was a lot of things going on in the country throughout April and May. And then we saw a recovery in the market into June. This is through June 10th. And what we've seen is where the market has fully come back on the S&P since January 1st at 2930 to 3204 on June 10th, 2020. But market volatility doesn't mean it's going to stay up and just keep going straight up. There's going to be volatility.
Absolutely. And that line going back up there is based on hope for the future. Whatever the future brings, we have to adjust. The market will adjust based on what the outcomes are. So that's a forward-looking thing, and it's to be tested as time goes on.
Forward-looking without the support of real numbers. Many companies are struggling to get back to work, and that's causing market volatility with the emotions day by day. At Akers Financial Group, what we try to do with our clients is understand who you are. We start with a financial fingerprint. Some of the things we're going to do in this seminar today is we're going to talk about you and your retirement plan, what kind of volatility you're taking in your own plan. One thing that we want to make sure that you know that we have an offer for today, and that is this. We have a 12-page guide. It's called Recession Will Rob Your Retirement. You'll be able to download this article a little bit later in the webinar, but I want you to understand that there's a 12-page guide, something for you to read, but we're also going to have some other things, and that is going to be where you can talk to our team of advisors, Alex and myself here. We have a few other ones back at the office, but right now, Alex and I are doing this seminar. We want to talk about your financial fingerprint. That is where we start in your financial planning process. What we do here is, because no two fingerprints are alike, we try to take you and your exact situation. If you have pensions or income, stock market investments, or no risk at all, we take you from where you are to where you need to be.
And don't think that this financial planning is a lot of work. That's our job. That's what we do. We're here to help you do that. So I don't want people to get scared out there and think that this is some crazy thing that they have to do. No, that's what we do, and we love doing it.
Absolutely. So you can check us out at akersfinancial.com. Throughout the webinar, you have opportunities to chat with us on the right corner, and you also can download our guide, The Recession Will Rob Your Retirement. And of course, make sure you signed up using our calendar. We have that opportunity as we get to the end of this webinar later today. Now, timing is everything when it comes to the market. Hopefully what happens here is that the market has done its volatility and will just rise and keep rising during your retirement years.
I don't know if that's the case ever, Brian. There's
What are you
always
being all
going,
negative for? It's going straight to the moon, man, straight to the moon.
there's just too many unknowns out there for that to ever be the case. And if you want to go back in time, the stock market has always had ups and downs, just like the elevator business, you know, it goes up, goes down.
All right, so you got our two pictures on the corner. We just threw up two more pictures. We want to introduce you to Steve and Bill. These are brothers. They look pretty young to me, but they've been retired according to our story we're going to tell. So we brought in actors to protect the innocent. Is that the best way to put it, Alex?
Yes, absolutely.
All right, so what we're going to do in this scenario is we're going to try to explain the situation. They retire with the same amount of money in their 401k, 500,000. They're going to withdraw the same amount every year, which is 30,000. And then guess what? They're going to invest it exactly the same way. Everything they do is identical except when they retire.
So 1990 versus 2000. Wow, the 90s. What a bull run that was.
Absolutely. And then the 2000, Bill retired because he saw his brother. Let's go to this next slide. Actually, Steve, when he had his money, he put his 500,000 in, took 30,000 out, grew it to 1.2 million dollars over that 10-year period. Bill had the opposite effect, and that is his half a million took 30,000 out during the 2000. That was a 10-year time period where the S&P 500 was negative for a decade. He ended up with only 150,000 left after those 10 years. Let's go to the charts. Can you point out a few things there, Alex?
So the 30,000 withdrawal rate, let's just get that out on the table. That is a 6% withdrawal rate.
Way too high.
That is high.
We don't like 6%. What's the number that you like to work with, Alex?
4-ish.
4-ish?
Yeah. I don't want to lock myself into, a specific number because every case is a little bit different, but 6 is too high. That's always the case.
Absolutely. So you got Steve, he was taking 30,000 out. So in our scenarios, we think he started out wrong to start. And he had 100% of the money in the stock market.
Yeah, those are two big no-nos. I will not let a client do that.
Yes. So Steve, when he retired, the 90s was a bull market. You can see from 95 to 99, just 5 years in a row of growth. And that was a lot to do with the original tech bubble growing and then busting in 2000s. It grows for Steve, and his money he takes his 30,000 out at the end of every year, and he ends up losing the first year. Then he starts to grow with the big 20,000 his second year, and that money ends up growing to 1.2 million. Bill says, I'll take some of that. I'll take the same thing. Now, if the market's already going up, is that possible?
So Bill had some bad timing, right? And his brother, Steve, I guess Steve's always been the lucky one. If you ask them, I'm sure that's what they'd say. But
yeah.
If you look at Steve, after 5 years, his money is just about where it started. So even that 6% withdrawal rate is a difficult thing to keep up with, right? You don't want to eat your principal too early. You come over to his brother, Bill, he's 5 years in and he's $200,000 down. And what happens is when the market pulls back and you sell it, you're locking in your losses. So not only are you down 7% in 2001, you're also taking out 6% of what you started with. That number is a lot higher than 6% based on your balance at the end of the year. So this blanket withdrawal of 6% to start with just doesn't work out. All it takes is the first 3 years of negative returns, and he's shot.
Absolutely. So certain items here, we do not use the 6% withdrawal rate. We also find that the stock market is great for long-term growth, but it is not the way to do your predictable income for your retirement years. We rather have the first year of retirement income sitting on the side.
At least the first year, Brian. And we run across a lot of brokers or other advisors where they're selling every month for their client to generate this income. Now, I know it's good for them because they get to keep charging you that fee on the money while it's invested, but it is not the right answer for the person, because the stock market will be volatile. Anything that can go up like it does can also go down. So you have to make sure your income's planned out and it's done correctly.
Exactly right. So you don't want to have too many holes in your bucket. So when you're wanting to draw income out, having holes in your bucket, you can patch it sometimes, but we need to make sure it's not flowing out too fast. You need to have the proper amount of income that'll last a lifetime. You also don't want to just play the investment where you just flip a coin, right?
No, that's not the way to do it. And the retirement plan that we're offering people today, it's like the leaky bucket, Brian. You know, when you change the trash and there's a hole in the trash bag and it's leaking and you don't know it until you walk back from the trash can. Well, that's what we're here to do, right? We're that second opinion to show you, is your bucket leaking?
Yeah, is your bucket leaking? Or you're flipping a coin trying to pick your stocks? Not quite the best thing. Now, there's this 4% rule, which we think is okay to use if you monitor and implement and you keep track of what's going on a year by year basis. It's very important to keep track of what's going on, because when the market goes down, we are not withdrawing money in a down market out of the stock market, right, Alex?
No, you got to have balance. It also makes you a buyer. If you have other money and you don't need all your income that year, you can take some of your stuff that's not down and purchase the stock. So it makes you it makes you able to react in a positive way, not a negative way, for the fact that the market's going to be volatile.
And what we're going to be doing now is explaining a little bit about our friends Bill and Sharon. Bill and Sharon are a couple that are retired. They have $1 million that they've saved over a lifetime. And in our planning, we decided that we and they together, by building their fingerprint financial retirement plan, what we were able to do is come up with a plan of drawing $3,000 a month, which is $36,000 a year. And then we also have the ability to pull some extra money out per year. Now, the sad part here is if they want to buy a $30,000 pontoon boat, that $30,000 out of a retirement account, you just can't take 30. You got to take like 40-ish, 40,000 to get there. And that would actually make their withdrawal that year 7%, which is way too high. But in this example, this nest egg is providing for all kinds of things in their life.
And for $40,000, you're definitely going to want to get a better boat.
Absolutely. And actually maybe a better plan. So what we're talking about is this. When Bill and Sharon came in, we try to build models that are growth oriented, that will help us beat inflation over time. And then we build part of the income plan.
We're not saying that stocks are bad. You just need to know how they work and how they play a role in your retirement. The only place we're going to get that long-term growth is risk assets like the stock market. So it's got to be there to keep up with inflation. But when you're retired, you don't have the time to not take income. You can't just take a year off, right? You got to pay your bills. You got to live your life. So you have to work on that balance.
Right. So what we do by dividing things out, we use a thing where we take 100 minus your age. So if someone's 60 years old, we would say about 40% should be in growth, in equities, and then 60% needs to be protected from loss of the volatility in the market. So that when you have a global pandemic that's affecting your market, what you need to do is make sure that you don't lose your money and lose a great amount of money when those downturns occur, because big losses are hard to make up. So as we do this, what we're trying to say is that we want to talk about a written retirement income plan, even for you. And that's one of the things we want to talk about today, is that to take the volatility away, you need to build a plan. That plan has to know about your income, and has to know when you want it to start, how you want to build it, how you want to grow it. You got to make it work for you.
You got to know where it's coming from, Brian. There's a lot of different, people have long careers. They have different types of accounts. They have different places. So you got to know where to start.
Actually, when we're taking money out of the retirement accounts like 401ks, you also got to know about taxation and how much of it's taxed. Do you know Social Security's taxed?
I do, yeah.
I'm glad you do. That'd be scary if you didn't. A cost of living is one of the biggest things we got to be prepared for retirement from 2020 into the 2040 range. We got to be able to keep up with inflation over time. Market volatility might want to scare you away from stocks. We want you to have a proper portion. Make sure you are balanced because you need to make this money last as long as you do.
And cost of living is one of the biggest things that's overlooked out there. A lot of, the planning calculators that people have in their 401ks and such, they're using a 3% increase on Social Security. That's not going to happen. So you got to be realistic when you're doing your plan to make sure you have enough money to provide the life that you want.
So when we get together, what we try to do is sit down with you and try to identify where you are now. We call that your unique financial fingerprint. By starting there, we can know where you are, we can identify your goals, and identify how to make your goals a reality into and through your retirement years. So what we do is we put together, we have a meeting, and that meeting right now is through the phone or Zoom meetings. And what we do is we do this thing called, Are You Retirement Ready? It's an income plan that we present to you in writing.
And this will show you the math on projecting out a potential 30-year retirement. It's very easy your first year in retirement to think, oh, I have $1 million. Well, I can go ahead and buy a boat and take my money out. Well, that million's got to last for up 30 plus years. I mean, with medicine the way it is, it could be a very long time.
We generally say in your 60s, you want to live off the interest and dividends. You don't want to eat the principal. In the 70s and 80s, you got to work within the system of what you need and make that money try to last as long as you do. So 3 most important things that we all need to know, and that we need to know your financial fingerprint. If we can help you, we need to know that. And also, if you want our help. So one of the things we want you to do is to sign up for a free visit with us. That visit is where we talk. We talk through video, we talk through the phone, and we communicate to a point where we see about what we can do to help you. We, of course, have that 12-page Recession Will Rob Your Retirement guide you can get, but we also want to recommend the main thing, and that is to take these thoughts, these things that might concern you, and get an advisor, get a coach that's going to walk you through what's going on in your life. So in summary, what you got to do is ensure that you're not overly exposed to risk.
Yeah, risk can be a bad thing, but risk can also be a good thing. You just need to know what it means for you.
You got to protect yourself from market timing and from guessing the market, right?
We know for a fact that the stock market's going to be volatile. Why wouldn't we do something to prevent that impacting us?
And we need to create an actual written income plan to help you manage market volatility.
And
we have a radio show on Saturday mornings, Winning in Retirement. Alex, got any final comments?
Now, this is one of my favorite topics, Brian, because I know people are out there not doing it right, and I want people to win in retirement for not being too cliche.
So check us out, akersfinancial.com. Check out our radio show. But most important, give us a call. Click on that button and schedule a time with our advisors here in the near future. We do have 2 offices in Harford County and Baltimore County. We look forward to the day when we're able to meet face-to-face or without the mask, right? Right now, we're doing a lot of video and phone call reviews with our clients. Thank you for listening today. Thank you for the talk, Alex.
It's been fun, Brian.
And thank you for watching our webinar, and we look forward to meeting you soon.